Today we are going to have an important video, I would say, the discussion of the pilot paper. But before start off, I must say that there are few other videos where I discuss about the questions relevant from the previous syllabus also, which are still valid, which are still relevant. So where that is crucial because those are exam type questions, and the pilot paper is what we have right now under the syllabus. So even any of the lecturers or anyone doesn't have an idea exactly how the exam is going to be. We can only predict or guess, and what we were told was it will be almost similar to the pilot paper, so we'll discuss that. But when you go through the pilot paper, you will see, my dear students, some questions are very easy. So we may not expect that type of an easy question at the exam. So what I'll do is I'll do another video with few model questions or targeted questions for the exam, a little bit higher in advanced level. But since it's the first exam under the new syllabus, probably it may not be that difficult also. But we never know. So I don't want to make predictions on that. Today we'll go through these questions and answers. You also can refer to the suggested answers published by Chartered Institute as well. But there may be certain areas where you are not, the suggested answers do not explain everything. So that is where I'm going to help you. But apart from that, please go through my other revision videos on what you call the required the questions, the past paper questions and all. Even though they are from previous syllabus, some are still relevant. But we are going to tap on my today. You will see, especially on the theoretical areas, how the examiner might be looking at things, how the examiner might test certain theoretical areas. Because now the syllabus is kind of like, unless earlier it was like more like 70% calculations, 30% theory, or maybe 80% calculations, 20% theory. Definitely 60%, more than 60% was calculations. But now how the structure goes on, it's like 50-50, 50% theory, 50% calculations, right? So on the theoretical areas, even though some of these questions might look so easy, this is giving us an idea about how the theory will be tested at the exam. So it's a learning curve for everyone. It's like, first exam might not be that hard. Eventually it will become harder. So then we'll be having past papers and we can get an idea about what the examiner might be testing on or might be focusing on. But right now we don't have much of an idea. So I will do my best to cover what is possible, and please work with me and please contact me or just let me know in whatever the form if there are any difficulties for you when you are attempting these questions. So with that understanding, we will look at what you call the pilot paper. I'll start off with the first question. Right? So you can take a couple of minutes to read the question and understand. Yeah, so we'll go through. Having passed out as a certified corporate accountant of CASriLanka, you have been recruited as the corporate management accountant at Oceanic Food and Textiles Private Limited. So you are being recruited as, this is about strategic management accountant's role. Now whenever you get the questions, my dear students, it's a 3-hour paper, same structure, nothing different from our previous syllabus, right? Section A, no, the content is slightly different. You are getting 15 minutes of reading and planning, writing 3 hours. So reading and planning time, you can't write, but you can read the questions. There I recommend you not to read the entire question, but look at what is being asked. I'll show that approach and just identify the areas where you are going to attempt first. Section A, 5 questions compulsory. 5 questions compulsory. Section 3, B, 3 questions, answer any 2. So you have an option to omit 1 question, answer any of the 2 questions. So I think these are carrying question 1, it carries 10 marks. So 10 marks into 5, 10 marks into 5, 5 questions of 10 marks, 50 marks, and 2 questions of 25 each. Right, so this is a closed book examination. Begin each answer on a separate page. Read the instructions carefully. If you complete, or if you halfway complete 1 question, if you are starting a new question, go for a new page, right? Separate page or new paper you get. You can ask for enough papers. Answer should be in English language and answer should be written on the answer booklets. Graph papers and any other stationery distributed at the examination hall only are considered. So if there's a graph to be drawn, I don't think now we are getting that linear programming and all, not going into that detail. But apart from that, it's the answer sheets that you need to follow. But if you're running out of paper, always you can request. So here, basically, we'll read it again. Having passed out as a certified corporate accountant of CASriLanka, you have been recruited as a corporate management accountant at Oceanic Food Textiles Private Limited, corporate management accountant, to provide a leadership to the team. Now, my approach earlier, during that 15 minutes time, without reading all these things, distinguish the historical and modern roles of management accountants. The role of management accountant as a strategic partner, strategic role of management accountant, historical role and the current role, right? Present 3 key capabilities required to influence business decision. Key capabilities, all these things we are studying. Chapter A, the videos, please go through again if you can't remember. So that's the kind of revision that we are having. Discuss how this role transformation from traditional reporting to strategic business partnering adds value to agriculture and textile divisions of OFT and OFT as a whole. So this is agriculture and textile they are into. How this role transformation adds value is what we need to discuss. It says discuss the keyword distinguish. Venasa kiyanone. Present, you have to present 3 key capabilities. Discuss, you'll have to do a discussion. So it's carrying 4 marks. Some explanation is required. The keywords are very important. These are given in bold colors, my dear students. So look at those. Look at those. Right? And now we'll read the question again. So you have been recruited to the corporate management accountant as Oceanic Foods and Textiles Private Limited, OFT, to provide leadership to a team of management assistants who have been there for 5+ years. Who have been there for 5+ years. Okay. Who have been there, provide leadership to a team of management assistants. To a team of management assistants who have been there for 5+ years. They are assistants. They have been in the company for 5+ years. Now you are going to give the leadership. See the challenges that we face. Now you are getting qualified, right? You go up in your qualification. You are going for a new post. It's a senior post, corporate management accountant. So you are giving a leadership to a team where they are already having some experience in that organization. Agriculture and textile are the 2 largest business SBUs. Agriculture and textile are the 2 largest strategic business units. Strategic business units are also known as SBUs, agriculture and textiles. The agriculture division faces frequent commodity price fluctuations. Agriculture division, you have a problem, frequent commodity price fluctuations that affect planning, cost control and profitability. That affects planning, cost control and profitability. Right? The textile division operates in a highly competitive global market where timely cost analysis, dynamic pricing and efficiency improvements are critical. Highly competitive global market where timely cost analysis, dynamic pricing and efficiency improvements are critical. Right? Timely cost analysis, dynamic pricing and efficiency improvements are critical. Both divisions still rely on traditional monthly reporting cycles and backward-looking financial analysis. Which limits the finance team's ability to influence operational and strategic decisions. Both divisions still rely on traditional monthly reporting cycles. Okay, both divisions still rely on traditional monthly reporting cycles and backward-looking financial analysis. So, agriculture division, they have their own set of problems. Textile division, they have their own set of problems. Okay. Both divisions still rely on traditional monthly reporting cycles. Okay, traditional monthly reporting cycles and backward looking financial analysis, going back, feedback analysis, right? Going back. We learned that in the feedback versus feed forward. In budgeting, we talk about it, which limits the finance team's ability to influence operational and strategic decisions. Limits the finance team's ability to influence, okay, operational and strategic decisions. So, since these management accountants are looking, or these divisions are looking at monthly reporting cycle and backward looking financial analysis, there's a limitation for finance team's ability to influence operational and strategic decisions, because it should be forward looking, it should be like futuristic, it should be helping the strategic achievements, right? So that's somewhere there's a lacking in both divisions. Your chief financial officer, CFO, is compiling a report showing how the finance function compiling a report for how the finance function can move beyond historical reporting and cost control to become a strategic business partner, right? Move beyond historical reporting and cost control and become a strategic business partner. You are expected to provide insights that help operational teams support cross-functional decision making and contribute to divisional and organizational performance. You are expected to provide insights that help operational teams support cross-functional decision making and contribute to divisional and organizational performance. Right? So you are expected to provide insights that help operational teams, okay, right? Help operational teams support cross-functional decision making. We need to help operational teams support cross-functional decision making, and contribute to divisional and organizational performance. Okay. The management wants evidence of how forward-looking analysis, scenario planning and collaboration with functions such as operations, marketing and supply chain can create value. The management wants evidence how forward-looking analysis, now they are doing backward financial analysis, no? So forward-looking analysis, scenario planning and collaboration with functions such as operation, marketing and supply chain. Always we say strategic management accountant's role is to collaborate with different functions like operations, marketing and supply chain and can create value. Distinguish the historical and modern roles of management accountant. What was the traditional looking of the management accountant's role and what are the current trends are like the novel thinking of management accountant's role. So we are going to answer to that. So this question, my dear students, is entirely on the theory. Strategic management accountant's role. Entirely on the theory. Yeah. Historical and modern role of management accountant. Okay, we'll just note down, or you can have a table, or you can just write down. So, pilot paper, question 1, part A, historical role. Historical role of management accountant. So he was more like a cost controller, right? Or the traditional scorekeeper, we say. Traditional scorekeeper, kind of. It's the word being used. Traditional scorekeeper. Right? So what are the roles? Right? So one is that they are mostly into cost controlling aspect, focused primarily on cost control, bookkeeping and historical reporting. Backward reporting they are looking at. Right? Focused on cost controlling, cost accountants, no. Initially we had cost accountants, not the management accountant. Cost control, bookkeeping, it could be cost bookkeeping or sometimes finance bookkeeping also. Both were like taken parallelly at that point. And also it's about historical reporting. Historical reporting. So focused on cost control, bookkeeping and the traditional historical reporting. So now management accounts is about the present and the future, futuristic reporting. Historical reporting goes for the financial accountants, right? So that is one aspect. What else? Yeah, what else? So it's kind of like they are providing monthly or periodic financial reports with lagging indicators, kind of like they give monthly or quarterly or periodic financial reports. The KPIs are past, lagging or past indicators. Providing, because even this question they are speaking about the two departments, okay, the two SBUs, right? So one of the problems is that they have the backward looking financial analysis is there and traditional monthly reporting cycle. So it's a part of traditional historical management accounting function, right? Providing monthly or quarterly, within brackets we can say periodic reports, periodic reports, okay, periodic reports, financial reports with past KPIs, periodic financial reports you can say, financial reports with past KPIs, past or lagging KPIs, key performance indicators, KPIs, key performance indicators, okay, key performance indicators. So also the traditional management accountant, they are operating, now anybody within the traditional concept, like they are working in their own silos, functional silos. They are worried about only the management accountant's function. No integration with marketing, supply chain, or maybe operations or any other function, right? There's no limited interaction. And also what they provide as for the strategic decision making and forward looking decision making, the input provided is minimum. Okay. Operating in all operating in on functional silos, with minimum interaction, or connectivity with other functions such as minimum interaction or connectivity with other functions such as marketing, operations, or supply chain. Okay. Also number 4 you can write down kind of like the input provided is minimum for the strategic decision making, strategic and forward looking decision making. Input provided for strategic and forward looking decision making, forward looking decision making is minimum or extremely limited, extremely limited. Right. So that's about the traditional historical scorekeeper's role, right? Now the modern role as a strategic partner, what are the changes that came up? So actually you can develop your answers through what we have written here as well. You are not historical reporting, you are about forward looking, right? So not about the past. Then you are not working in silos, right? And the input provided will be maximum because you are always interacting with the others and you are always like a strategic value partner, right? So we'll say modern role. Modern role of management accountant. Modern role of management accountant. Modern role of management accountant as a strategic business partner. That's a strategic business partner. If you it's not mandatory to write it, but I'm just writing. Strategic business partner. Okay. Now there, so it's forward looking, giving inputs on strategy, right? Feed forward looking, data driven insights are there, support proactive decision making. Being forward looking, okay. Insights from the data-driven background, right? Data-driven insights and support proactive decision making. I will say providing forward-looking, yeah. Providing forward-looking data-driven insights that support proactive decision making. Data-driven insights that support proactive decision making. Okay. Collaborates with operational teams and other strategic functions. Like you are not working in silos, you are collaborating with other strategic functions. Yeah, instead of working in silos, collaborating with other functions, other strategic functions or operational teams. Operational teams and strategic functions. Operational teams and strategic functions. Example, again I'm repeating what I wrote under historical aspect: marketing, supply chain, and maybe operations. Those are the key, but there can be other things also, other functions as well. Any logistics, there can be other supportive functions, but core functions are marketing, supply chain, and operations. Yeah. So, like the strategic partner, as a strategic partner, they are contributing to shaping the strategy, risk management, and long-term business performance, right? contribution to shape up organizational strategy, and the risk management function and long-term business performance. Risk management and business performance in the long run. Business performance in the long run. So we have to just point out like this, differentiate, no, distinguish, no, the differences we are talking about, like 3 points even fine, 3 marks are given, I'm giving 4. Yeah, they are supporting, like we can, as a management account, we can support investment appraisal, scenario planning, anything such as resource allocations and all. Supporting or performing even, yeah, supporting investment appraisal, resource allocation, for that you can support network analysis and all, resource allocation, and what? Scenario planning, etc. Right, so let's look at the next question. Yeah, the next question. Present 3 capabilities required to influence business. To influence business decision, what are the key capabilities required? Right, so they are talking about the technical competency, business acumen, business like the knowledge and understanding, then leadership and influence skills. Okay, so there are 3 key capabilities. 3 key capabilities required to influence business decisions. So since like they are asking the question in the sense, asking the question, present, just listing won't do. If they say list, you can just write down the 3. Present means you can slightly explain it, right? Slightly explain, okay? Key capabilities required to influence business. Key capabilities required to influence business. Key capabilities required to influence business. Okay, right? So number 1 is technical competencies. Technical competencies. What are the technical competencies that you require? If you can't remember, just go back to those slides where I speak a lot about these things. Technical competencies like financial modeling, predictive analytics, forecasting, scenario planning or scenario analysis, and ability to analyze large sets of data, data analysis, provide actionable insights. Okay, so examples can be financial modeling, predictive analytics, predictive analytics, okay, forecasting, scenario planning, forecasting, scenario planning or scenario analysis rather, scenario analysis. Now you can, search all these things in detail if something is not covered, right? And analyze large data sets, right? And analysis of large data sets, okay. So let me give you an understanding on this scenario analysis a little bit. So scenario analysis is a risk management and forecasting technique used to evaluate future outcomes by modeling different possible events, mapping out optimistic, baseline and pessimistic scenarios like what we do in decision theory, okay, right? So it's a kind of a modeling again, right? Kind of a modeling, right? Kind of a modeling. Okay. Right? So optimistic, pessimistic and the base case or the average outcome, right? The three core scenarios are there. So that's something that we are looking at. Okay. Now business acumen, right? That's a business understanding that you have. The second competency is business acumen. Business acumen. So these questions we need to complete quickly. I'm taking time and explaining, but 10 mark questions maximum within 15 to 18 minutes you should be able to complete. Just write down quickly if you know the answers. If you don't know the answers, it's a problem, then that's why you need to study. Study hard. Understand the divisional operations, marketing conditions, value drivers, okay, like ABC costing and all, we talk about the cost drivers, profitability, awareness of competitive pressures and industry specific challenges, right? Simply it's the business knowledge and understanding. Business knowledge and understanding. Business knowledge and understanding. Ability to make good judgments and quick, accurate decisions, right? That would help make quick, accurate decisions. Quick, accurate decisions. Okay. Right, so we'll go for some examples. This E dot G dot, some people ask this question from me. Example, when you write as example. So why not put EX? Why not we put EX? Why go for E dot G dot? Remember, E dot G dot is a Latin version that talks about exemplary gratia, right? Exemplar gratia, exemplary gratia, right? So E dot G dot is the short form, but that's coming from the Latin language. For example, exemplary gratia, right? For example, කියන එක තමයි තේරුම. The meaning is for example. Yeah, so understanding that you gain on different divisional operations, good understanding on different divisional operations. Different market conditions, value drivers, profitability, competitive pressure, market conditions, value drivers, awareness of competitive pressure and industry specific challenges, competitive pressure, knowledge or awareness on competitive pressure or industry specific challenges. Industry specific challenges. So you need to have a knowledge and understanding about the business, right? About operations happening in other divisions. What's the current market context, market condition? What are the value drivers, like which we have the cost drivers who absorb, who help recognize the overhead cost. No? So likewise, what are the drivers that create value to the business? Where can you create value, right? Then any knowledge or awareness on the competitive pressure, it's a part of the market conditions, but how much pressure we are having from the competitors, and any industry specific challenges. Now maybe with the Middle East war and all, or imposition of tariff from US, certain export industries are affected, right? Not just Sri Lanka, in any India and all other countries. Like if they had been exporting to US, right, or maybe the European markets or somewhere there, going across Middle East is a challenge, and US imposing tariffs are also affecting their export, the margins and all. So that's industry specific challenges. There can be other industry specific challenges, like if there's, let's say, some industry where the raw material is not available right now, or raw material prices have gone up in the global market. That may be an industry specific challenge. Okay. So that's on business. Leadership and influence skills. Leadership and influence skills. So that's inclusive of communication. Leadership and influence skills. Influence skills. Leadership and influence skills. Clear communication. Okay. Like if there is a complicated financial data or an information, how to communicate that to non-financial people in a simple manner. That's very challenging, but that's a leadership skill that we need to develop. Building relationship and collaboration with operational strategy. Other teams, you build up relationships and collaborations. Supporting change management initiatives and promoting evidence-based decision making. Supporting change management initiatives, promoting evidence-based decision making. Okay, so we'll write down. Ability to communicate complicated financial information, ability to communicate complicated financial information to non-finance stakeholders or non-finance people in a simple manner. To non-financial personnel people කියන එක in a simple manner. How do you communicate those in a simple manner? Okay. Right. Then networking, collaboration, building relationship. Building relationship, networking, collaboration, with both operational level team members and strategic level team members. Both operational level and strategic level. Okay. So, three capabilities we looked at: the leadership and influential ability skills, then business acumen, the knowledge and understanding on the business to make quick, accurate decisions, and the technical competencies like financial modeling, predictive analysis, and all these analytical skills, scenario analysis, right? Mostly it's analytical skills, right? Okay. Discuss how the role transformation, the third question, part C. discuss how this role transformation from traditional reporting, to strategic business partnering, like how this role transformation from traditional reporting, to strategic business partnering adds value to the agriculture and textile divisions and OFT, the organization as a whole. If you are moving from traditional reporting to strategic business partnering, how does it add value, right? How does it add value is what they are talking about. Okay, so let's see. So the role of transformation from the traditional management accountant to the strategic management accountant, strategic business partnering. How that affects to agriculture division, textile division and the organization as a whole. Right. Right. So the role transformation, it carries 4 marks. So some sort of a discussion, some sort of an explanation, not a very big explanation, but a simple explanation is required. The role transformation involves shifting from traditional reporting to what do you call, more proactive, more strategic partner. Traditional reporting and cost control, maybe. Traditional reporting and cost control to active participation as a strategic partner. To active participation as a strategic partner. Active participation as a strategic partner. Right? Right, so we'll have to look at how this is applicable for an agriculture department, the textile department, agriculture SBU, textile SBU, as well as cross-functional and the overall organization, right? Now, there we need to just look at, okay, the question. You need to get some insights from what we underlined here. Agriculture division faces frequent commodity price fluctuations that affect planning, cost control and profitability. So as the management accountant, analyzing commodity price volatility and maybe to do a financial model how this price fluctuation affects their revenue and profitability. Okay. right? So commodity price fluctuations. Textile divisions will come to that. So beforehand, so they should be able to support, as management account must be able to support the correct pricing decision. If there is any hedging involved, like you say, you have the aggressive approach, the consecutive approach, or maybe conservative approach and the aggressive approach, and the perfect hedge, the hedge, like how you basically come to an agreed price, okay, come to an agreed price. Right? It's a kind of a strategy that is used to minimize the losses or minimize the risks. Okay? Right. So we'll say agriculture division. Agriculture division. Agriculture division. Okay. Or agriculture SBU if you want, you can put. So as a management accountant, we'll have to do this price variation analysis, analyze commodity price volatility. So our question is on discuss the role of transformation adds value to the agriculture textile division and OFT as a whole. Value addition we are talking about, right? The value addition we are talking about. So as management accountant, being a strategic partner now, right? Supporting analysis of price variation, supporting analysis of price variation, and the model, I mean, if possible, do a model, financial modeling, how this impacts, these changes impacts the revenue and profitability, and performing a financial modeling on how these variations impact revenue and profitability. Impact revenue and profitability. Okay, right. Also, support may be given for budgeting process. Support may be given for budgeting process and decision making. And decisions on best pricing decisions. We learned pricing and transfer pricing, right? Pricing and hedging. What is hedging? Minimizing the loss. Minimizing the loss of, what do you call, minimizing the loss, I would say, on like the loss that we make due to incorrect pricing. It's like a gamble sometimes, right? So if you don't make the correct price, you might lose out either through sales, less quantities, or maybe you're losing out on your price. Others are selling at a higher price, right? Strategy used to limit potential losses and risks. Minimizing, or I would say we will use like that. Hedging means strategy used to limit losses and risks. Losses and risks. Losses and risks. Then what about the textile division? Textile SBU or textile division. Textile division. Now the textile division operates in a highly competitive global market where timely cost analysis, dynamic pricing and efficiency improvements are critical. Timely cost analysis, dynamic pricing and efficiency improvements are critical. Okay. Timely cost analysis, dynamic pricing, efficiency improvement. Both divisions to rely on traditional monthly reporting cycles and backward financial analysis and all, right? Okay. So we need timely, real-time costs, okay, and margin analysis and with the pricing. And efficiency improvements, right? So, okay, we'll say management accountant may analyze and support with commodity price volatility, commodity price changes, because they talk about price changes, right? Yeah. Sorry, they talk about real-time costing. Sorry about it. Real-time costing and margin analysis. Real-time costing and margin analysis, real-time costing and margin analysis that supports the dynamic pricing and the competitive positions. That supports dynamic pricing and what do you call competitive position, market positioning, competitive or market positioning. Okay. So further, management account can support, identify areas where they can improve on efficiency, because they are talking about efficiency improvements are critical. Also, the management accountant can support identifying areas or elements, I would say, for improvement of operational efficiency. It's operation team's duty, but management accountant can support for that. Operational efficiency. කාර්යක්ෂමතාව වැඩි කරගන්න අවශ්‍ය කොයි තැන්වලින් මේක අයිඩෙන්ටිෆයි කරගෙන ඒක ඉම්ප්‍රූව් කරගන්න පුළුවන් කියන එක මැනේජ්මන්ට් අකවුන්ටන්ට් උදව් කරන්න පුළුවන් operations team එකට ඒක අයිඩෙන්ටිෆයි කරන්න, right? So management accountant can support the operations team to identify on what areas where improvements can be done so that overall operational efficiency will increase. Okay? Right. So overall organization, so we would say overall organization, OTF, and cross-functional impact. And cross-functional impact. Okay. So it's about like improving the collaboration. Like one thing is like it's always about cross-functional improvement. We are talking about not to work in silos and improve the connectivity and the relationship, the collaboration with other core functions such as operations, marketing and supply chain. Right? Then contribute towards scenario planning, risk assessment at divisional and organizational level. Improve overall decision making, resource allocation and long-term value creation. Demonstrate measurable business impact through increased profitability, reduced risks, and support for sustainable growth initiatives. Measurable business impact through increased profitability, reduced risk, and support for sustainable growth initiatives. Right? So there we can say management accountant, the modern management accountant who is a strategic partner, accountant can collaborate with can improve or enhance වැඩි කරනවා collaboration with other cross functions such as operations, marketing and supply chain. Operations, marketing and supply chain. Okay. Right. This would help, since it's a discussion, this would help better alignment with strategic objectives. Financial insights, this would help financial insights better aligning with strategic decisions. Better aligning with strategic decisions, strategic objectives, I would say, strategic objectives. Strategic objectives. Also, we can talk about you can help overall decision making, resource allocation, long-term value creation, scenario planning and risk assessment, demonstrate measurable business impact through increased profitability, reduced risk, support for sustainable growth initiatives. So you don't have to write down everything, but we can say contribution towards the followings are vital. Vital means importance, වැදගත්. Okay, I'll write down one by one. Improvement in overall decision making. Improvement in overall decision making. Improvement in overall decision making. Okay. Resource allocation. Resource allocation. Resource allocation. Right? Scenario planning. Scenario planning. Resource allocation, scenario planning, long-term value creation, risk assessment, Risk assessment I'll come later. I'll say scenario planning. Scenario planning. Risk assessment. Risk assessment at organizational level and divisional level. Cross-functional also we are talking about. Entire organizational level. Organizational level. Organizational level and divisional level. Divisional level. Okay, divisional level. Long-term value creation. You don't have to write down everything, but I'm giving the list. Long-term value. You see now the theory aspect is tested in this question, right? I mean, the chapter A is mostly theory, right? Demonstrate measurable business impact through increased profitability, reduced risk and support for sustainable growth initiative. Demonstrating measurable business impact. Demonstrating measurable business impact through increased profitability, increased profitability, reduced risks, risk එක අඩු කරනවා, reduced risk and support for sustainable growth initiative. Support for sustainable growth initiative. Support for sustainable growth initiative. So that is more than enough, but even if you don't write all this much for 4 marks, you write down like whatever required. So 1 point on agriculture SBU, 1 point on textile SBU and 2 points maybe on the organization and the cross-functional aspects would do. I've given multiples for you to think. Yeah, so we'll go through the question number 2, right? Question number 2. Okay. You are the newly recruited corporate management accountant at Pacific Electronics Private Limited or PEL, Pacific Electronics Private Limited or PEL, a company that manufactures consumer electronics for domestic and international markets. So they are manufacturing consumer electronics for domestic and international markets both, right? So local sales as well as international foreign sales they are targeting. The company is preparing its annual budget for domestic and international markets. The company is preparing its annual budget for the next financial year. Last year the total operating expenses were 120 million. Of which marketing department accounted for 5 million as follows. Out of the operating expenses 120 million, 5 million has been for marketing department. So that was like 2.4 million for 12 advertising campaigns, 1.6 million for 8 sales promotions, 1 million for 5 market research programs. So like 5 million, 2.4 million for advertising campaigns, 1.6 for sales promotions, and 1 million for 5 market research programs. The marketing department has planned 15 advertising campaigns. Marketing department has planned 15 advertising campaigns, 10 sales promotions, and 4 market research programs for next year. So marketing department has planned 15 advertising campaigns, okay, 15 advertising campaigns and 10 sales promotions and 4 market research programs for the next year. So it's a variable cost, my dear students. Now you see here in this case 2.4 million for 12 advertising campaigns. So what had been per advertising campaign cost, we can find out. 1.6 million for 8 sales promotions. How much for 1 sales promotion? You can find out by dividing 1.6 million by 8. 1 million for 5 market research programs. Per market research program, 1 million divided by 5. You get that cost. Now this time we are budgeting or planning 15 advertising campaigns, 10 sales promotions, and 4 market research programs for the next year. PFL expects 16% revenue growth next year. 16% revenue growth next year, and estimates operating expenses will also increase at the same operating expenses also at the same rate. Revenue will inflate or grow by 16%. Operating expenses also will increase by 16%. According in the first draft budget, 5.8 million has been allocated for marketing department. So 5.8 million has been allocated for marketing department, assuming a 16% increase, because earlier last year you had 5 million, now 5.8 million. 5 million into 116% if you apply 100% plus another 16%, it will be 5.8 million. You can calculate and see. Quickly check in your calculator these things, right? Okay. The company is planning to launch a new smart home product line, which involves uncertain demand forecast and volatile raw material costs. So they are planning to launch a new smart home product line, which involves uncertain demand forecast and volatile raw material costs, volatile raw material costs. The Chief Executive Officer, CEO, and the Operations Manager of PEL are concerned that incremental budgeting may not sufficiently align resources with the strategic priorities or identify cost-saving opportunities. The Chief Executive Officer, CEO, and the Operations Manager of PEL are concerned that incremental budgeting may not sufficiently align resources with strategic priorities. So right now they are focusing on incremental budgeting. Compared to the last year budget, you apply the growth rate or whatever the increment percentage to the budgeting. May not sufficiently align resources with the strategic priorities. So this is to do with budgeting. Or identify cost saving opportunities. Okay, good. They are considering alternative approaches such as zero-based budgeting, activity-based budgeting, Kaizen budgeting, etc. to improve cost efficiency, encourage operational accountability, and support strategic decision making. Encourage operational accountability and support strategic decision making, etc. Right? The finance team is expected to analyze how different budgeting approaches can guide resource allocation, ensure cost effectiveness, and enhance operational planning. the finance team is expected to analyze how different budgeting approaches can guide resource allocation, ensure cost effectiveness, and enhance operational planning. So, finance team, the management accountant and the finance team is expected to analyze, or you may be part of the finance team, no? How different budgeting approach, what are the different budgeting approaches they spoke about? Zero-based budgeting, activity-based budgeting, and Kaizen budgeting. Here, and even incremental budgeting we can look at. Describe activity-based budgeting and Kaizen budgeting, highlighting their principal benefits. So we know that activity-based budgeting is based on the budgeting based on activity-based costing, right? Based on activities and cost drivers rather than historical expenditure. Focuses on understanding cost drivers and linking resources to operational activities. The benefits are more accurate cost allocation of costs to department, products and processes, support informed decision making and resource optimization, helps identify inefficiencies and reduce waste. Yeah, so what is activity based budgeting, and then we'll move on to what is Kaizen budgeting. Okay. So we will say the question is on describe activity based budgeting, Kaizen budgeting, highlighting the principal benefits. Question number 2, part A, activity based budgeting. So there again a theory is being tested, but they might test calculations also as we go on. Activity based budgeting. Okay, budgeting based on activity based costing, or activities that drive costs. So here budgets are prepared based on activity based costing, activity based costing, or in other words ABC principles. I dot E dot stands for that is, okay, I dot E dot, that is activities or work done. Please go through my ABC costing videos and budgeting videos that drive costs, okay. Focuses on identifying cost drivers, identifying cost drivers, and allocating or linking resources to operational activities. to operational activities. So what are the principal benefits? So giving attention to, they say, principal benefits, right? Highlighting their principal benefits. So principal benefits. Principal benefits. Principal benefits. More accurate allocation or apportionment of costs to cost objects like the departments, products or processes. More accurate allocation or recognition. Recognition is the best word. We can't say absorption. This activity-based costing is beyond absorption. Allocation or recognition of costs to cost objects such as departments, products or processes. Right. Supports informed decision making and resource optimization, helps identify inefficiency. Number 2. Supports informed decision making and resource optimization. Informed decision making and resource optimization. Helps identification of inefficiencies and reduces wastes. Helps identification of resources and identification of inefficiencies, inefficiencies and reduction of wastes. Reduction of wastes. Yeah. So then what is Kaizen budgeting? We know Kaizen means continuous improvement. Kaizen budgeting. Kaizen is continuous improvement, right? So focuses on continuous improvements, assuming the costs will decrease over the time through efficiency gains. Not initial drastic reduction is the target costing, but here Kaizen, overall the cost will decrease over time with the efficiency gains. Continuous improvement. So they are setting targets for cost reduction based on operational improvements rather than static historical figures. So what are the principal benefits? Encourage a culture of ongoing efficiency and process improvement, provides realistic targets for cost control and productivity, aligns budgeting with long-term organizational improvement goals. Right? Right. So Kaizen budgeting focuses on continuous improvement. That is what we call as Kaizen. Continuous improvement or Kaizen assuming the costs will decrease over a period of time through efficiency gains. Assuming costs will decrease over a period of time through efficiency gains. Through efficiency gains. Right. So they are setting targets for cost reduction based on operational improvements rather than historical figures. Targets are set for cost reduction. Targets are set for cost reduction based on operational improvements, instead of historical figures. Unlike incremental budgeting where you are looking at last year or last few years and applying a growth rate or something, it's not like that. Principal benefits. Mulikawasi, principal benefits. It's realistic. It's encouraging a culture of ongoing efficiency and process improvement. Encouraging a culture of ongoing efficiency and ongoing efficiency improvements, right? Ongoing efficiency and process improvements. Efficiency improvements as well as process improvement. Process improvements. Ongoing efficiency and process improvements. Okay. Providing realistic targets for cost control and productivity. Giving realistic targets. For cost control and productivity. Okay. Aligning budgeting with long-term organizational improvement goals. Aligning budgeting with long-term organizational improvement goals. Aligning budgeting with long-term organizational improvement goals. Right. Let's look at the balance part of the question. Examine the first draft of the operating expenditure budget and marketing department budget considering the perspective of the CEO and operations manager. First half of the operating, now it's based on incremental budgeting. No? So based on the perspective of, considering the perspectives of CEOs and operation manager, like they are of the view, incremental budgeting may not sufficiently align resources with strategic priorities or identify cost saving opportunities. They are considering alternative approaches such as zero-based budgeting, activity-based budgeting, and Kaizen budgeting. Okay? Right. So we can look at zero-based budgeting and activity-based budgeting. Right, so we have to first draft of the operating expenditure budget and marketing department budget, considering the perspective of the CEOs. And I want to explain two circumstances in which incremental budget would be an appropriate budgeting approach for PEL. Okay, not a difficult question this is, but we cannot expect the same pattern at the exam, even though institute has promised that it will be in line with the pilot paper. So I don't know, like we look at some difficult questions also. Right, so marketing budget and the operational budget. So operational budget they are not giving separately. Marketing budget. Yeah, so we'll just do the activity based approach. Marketing budget based on ABB, activity based budgeting, and zero based budgeting approach. Okay. So what we can do here is, as I explained when I was explaining the sum, 2.4 million is for 12 advertising campaigns. So per advertising campaign, per activity, the cost we can identify. Sorry. Cost per activity. Cost per activity based on the previous year. Based on the previous year. Okay. Cost per activity based on the previous year. Right? So if you take advertising campaigns, the previous year they cost in rupees millions or rupees, how much that is given? $2.4 million should be rupees. Okay. 2,400,000, right? Number of activities or number of advertising campaigns. Number of activities 12. So what we do is this divided by 12. Okay, is divided by 12. Okay. Yeah, cost per activity in rupees. Cost per activity. Cost per activity. Cost per activity in terms of rupees. Okay. So similarly, 1.6 million for 8 sales promotions. 1.6 million for 8 sales promotions. Sales promotions. Sales promotions. $1.6 million for 8 sales promotions. So in the same way, 1.6 million divided by 8, again you get 200,000. 200,000. 200,000. 1 million for 5 market research programs. Market researchers. Market research programs. Market research programs. 1 million for 5. 1 million for 5. 1 million for 5 divided by 5, again you get 200,000. So this is a very easy question. You won't get this much of easy question for the exam. Numbers can vary. Instead of 200, 300, 400, different things can come, but the principle is the same. Yeah. So budget for the expenses in the market. So budget for the expenses in the marketing department. So I'll go to the next screen. The budget. So advertising campaigns, they are talking about 15 advertising campaigns, 10 sales promotions, and 4 market research programs. Advertising campaigns, it will be 200,000 into 15. We are talking about this 200,000. So all are 200,000s. That's a silly question. Why they have, I don't know why they have, they could have easily changed it to 200, 250, 300, different values. But anyway, what to do? We'll go with this. It's 3 million. 3 million. Okay, advertising campaigns and sales promotions, 10 sales promotions. 10 sales promotions. 10 sales promotions, 10 sales promotions, okay, 10 sales promotions, sales promotions, sales promotions, 200,000 into 10, 2 million, and market research programs, market research programs, market research programs for 200,000 into 4, 800,000. So altogether 5.8 million, that incremental budget, even if you apply, you get 5.8 million. So here also it's like that. So that's the marketing budget. It's mostly activity based budgeting is involved, even though zero based budgeting concept also is there to some extent. So the total operating expenditure may not increase at the same rate as revenue, as all expense items are not variable. Together with the inflationary impact of each line item could have different levels of impact on operating expenses. Therefore, the increase in each item may be more or less. Now, if you look at compared to the last year, 2.4 million becomes 3 million. Okay, it's not the same 16 percentage. Then earlier it was 1.6 million became 2 million. It's like 25%, right? Previous one also was like 25%, and 1 million became 800,000. It's a reduction, right? So it may not be the same as what do you call the revenue growth. Revenue growth is 16%, it says. Revenue growth is 16%, it says, right? So but 5.8 million, the figure is showing 16% increment, but it's the method used to allocate 5.8 into minus the incremental budgeting approach is not appropriate. However, as per the calculation above, combination of ZBB and ABB will result in an answer of 5.8 million. Further, the company can apply Kaizen budgeting principles to consider whether there are any opportunities to reduce the cost of advertising campaigns, sales promotion, market research program. Required amount of resources may be less than 5.8 million. So to this you can say, right, so rate of increase in advertising campaigns is here 3 million minus 2.4 million, 3 million minus 2.4 million, 2.4 million over 2.4 million into 100. If you put 600,000 divided by 2.4 million, you do the calculation here to save the time. I'll quickly. It's 25%. By 25%, advertising campaigns go up because there's a 10-25% increase in the number of campaigns. Similarly, sales promotions also like that. Sales promotions, percentage increase in sales promotion cost, percentage increase in sales promotion cost. How to do that? Yeah. 2 million minus 1.6 million. Okay, 400,000 over 1.6 million, that is also 25%. So it's more than the revenue growth of 16%. But if you take marketing campaigns, it's a reduction. Market research programs rather. Market research program cost, market research program cost, market research program cost, $1 million is the older value, no, last year value, no. So minus 200,000 over 1 million into 100, it's a negative growth or reduction rather, minus 20%. So 20% reduction is there. So what we need to say is, to that you can add this sentence. You can note down. I'm not going to write everything on the board to save the time, because you can listen to this video again and again and again if you want. Therefore, the total operating expenditure, therefore, the total operating expenditure may not increase or decrease, at the same rate as the revenue increases or decreases, at the same rate as the revenue increases or decreases. With the inflation, Uddamani, you know inflation. With the inflation, different line items may have different levels of impact. Different line items may have different levels of impact on operating expenses. Therefore, the increase of each item can be the increase of each item can be more than or less than 16%. 16% is the revenue growth. More than or less than 16% as given above. We have shown the calculation also. As given above. As given above. Next point you can say, if incremental budgeting approach was used, if incremental budgeting approach was used, marketing department's budget, marketing department's budget, marketing department's budgeted expenses would be, marketing department's budgeted expenses would be 5 million into 116%, 16% increment, that is 5.8 million. 5.8 million. 5.8 million. Okay, to that we can say, as per above calculations, ZBB, zero-based budgeting, ZBB and ABB also resulted, ZBB and ABB also resulted in a total cost of 5.8 million. In a total cost of 5.8 million. We still got 5.8 million, but it's a different approach based on the activities. And with of zero-based budgeting, you think from the scratch, from the beginning. You eliminate all the previous year's assumptions. Okay? Next paragraph or the point you can write down, PEL, the company. PEL could apply could apply Kaizen budgeting principles, to consider whether there is any opportunity, කාලගුණය weather නෙමෙයි, this weather, WH weather, there is an opportunity to reduce the cost of advertising campaigns, sales promotions, and market research programs. Reduce the cost of advertising campaigns, sales promotions, and market research programs. Okay. Thereby the overall budgetary cost, or thereby the overall budgeted cost, we will say, thereby overall budgeted cost may be even less than 5.8 million with the Kaizen costing application. Therefore, the overall budgeted cost may be even less than 5.8 million. Okay, there's one last point for 2 marks. They are asking, explain 2 circumstances in which incremental budgeting would be an appropriating budgeting approach. 2 circumstances in which incremental budgeting would be an appropriate budgeting approach for PEL. Okay. Incremental budgeting would be an appropriate budgeting approach. Okay. So we'll write down. Incremental budgeting. So you'll have to identify, you'll have to recall the advantages or benefits of incremental budgeting. Would be an appropriate budgeting approach. Appropriate budgeting approach in what and what circumstances? If the market condition and the environment is stable, right? So then, like stable, so slight increase compared to the previous year, right? Or it's a mature organization. In the product life cycle, you come to the maturity stage, right? Or when there is no uncertainty or low level of uncertainty, so then conditions might prevail the same and go on. Or if there is limited time and resources to the preparation of the budget also, you can use it. So the question is given as explain two, like you'll have to explain those a little bit, right? So number 1 is, I would say, stable business environment. Stable business environment or low level of uncertainty. We'll take both together. Low level of uncertainty. Under that you can say, if PEL is the company, if PEL or the company operates in a stable business environment, where demand, production levels and cost structures, production levels and cost structures remain relatively unchanged, remain relatively unchanged. unchanged. Okay, relatively unchanged. Right, relatively unchanged from year on year, from year on year. With little volatility, with little volatility, variation, vichalatawa, little volatility on key cost drivers, such as RM prices, raw material prices, RM prices, RM prices, then labor rates and exchange rates, labor cost and exchange rates, labor costs and exchange rates, then this is the most simple and this is the simplest and the most cost efficient method. Then this is the simplest and the most cost efficient method. Cost efficient method of preparing budget. This is stable business environment. I'll erase these words for you when I'm dictating or when I was reading out the lines for you to make it easy. Only I wrote these things. You can listen the video again and again if you have any difficulty, but let me know if there's anything that you didn't understand. So, limited time and resources for budget preparation. Limited time and resources for budget preparation. Limited time and resources. Limited time and resources for budget preparation. Limited time and resources for budget preparation. Incremental budgeting is less time consuming and require minimum analysis. Right? So you can say appropriate in situations, appropriate in situations, appropriate, sudusui, suitable, appropriate in situations where there are resource constraints, limitations, resource constraints, there are resource constraints or time limitations. Time limitations because incremental budgeting is less time consuming, because incremental budgeting is less time consuming and requires minimal analysis. So they are asking only 2. This is more than enough, but I'll give you one more point. Minimal analysis. Okay. Number 3. If the organization or the product is matured. If the business organization, the company, if the organization or product is matured. Organization or product is matured. Right, so that means in the product life cycle they are reaching the maturity stage, right? Growth stage, introductory stage, and maybe the development stage and all, right? And declining stage. So maturity stage. In this maturity stage, it's rather stable again, right? If the company runs with, you can write down, if the company runs with established operations and mature product lines, if the company runs with established operations and mature product lines, with well understood processes, understood and tested processes, you can say, well understood processes and minimum inefficiencies. So if the product is matured or the production processes are matured, minimum inefficiencies, no inefficiencies. Inefficiencies. Incremental budgeting would be adequate. Incremental adjustments would be sufficient. It says incremental budgeting would be adequate, enough. So there will be another video on ESG framework, environmental costing, sustainability and governance aspect. Along with that, I will cover next 3 questions of the paper in the next video. Thank you so much.